Well, Malaysia's central bank unexpectedly raised its benchmark interest rate from a historical low in a bid to tackle inflationary pressures. It raised its overnight policy rate by a quarter of a percentage point to 2% from the record low of 1.75%. And with this, Malaysia joins a growing list of economies raising borrowing costs, trying to tame inflation, stoked in part by supply shocks caused by the war in Ukraine. The central bank says the economic growth is on a firmer footing, driven by strengthening domestic demand and exports, and that the monetary accommodation can now be eased as the unprecedented conditions arising from COVID-19 have abated. Malaysia's headline inflation in March rose by 2.2% on year. It is the lowest rate in Southeast Asia. Malaysia's economy returned to growth in the October to December quarter, expanding 3.6% from a year earlier. And central bank expects the rebound to continue this year. And for more, Melissa Goh joins us from Kuala Lumpur. Melissa, the central bank says the unprecedented conditions during the pandemic that called for the easing of rates have abated. But will there be more tightening moves soon?
Well, that depends, the central bank said, but any further hike in interest rate will be measured and gradual, depending on several factors, such as how adverse the military conflicts in Ukraine is going to be and the supply chain disruption, whether it's going to get worse further, as well as the commodity prices that have skyrocketed, driving up inflation all around. Now, in other words, what Malaysia Central Bank is doing is in line with many countries to try to rein in runaway prices, to try to curb inflationary pressures. Now, also, the central bank, Bank Negara, says growth is now on a firmer footing following the easing of restrictions and the reopening of the international borders on May 1st. Investment also has picked up a little. Domestic consumption has shined. I mean, it has already shot up a lot. Restaurants are always full, and the recent Eid celebration everywhere is quite packed. The malls, the supermarkets, Malaysians are shopping, and many analysts say that they are dipping into their retirement savings to spend. So Bank Negara's move to tighten monetary policy right now isn't really a surprise, although some businesses may be suffering because of higher financing costs now. Already employers are complaining about the higher minimum wage that's just been implemented by the government, as well as the sharp increase in raw materials, given the ringgit is now so weak against the US dollars. It's fallen more than 3% against the greenback the past month.
Yeah, and so Malaysia's headline inflation at 2.2% is the lowest in Southeast Asia. So this surprise hike appears to be preemptive. So what kind of challenges does the central bank foresee to the economic recovery then?
Well, yes, although inflation, headline inflation, is slated to edge up to 2% and 3% this year, it doesn't quite reflect the situation on the ground. And people are complaining of sharp increase in the cost of living. A weaker ringgit doesn't help. Imported goods are so expensive now, but a cheaper ringgit does help Malaysians' exports, though. So that's good. So the challenge is whether Malaysia's economy can strengthen fast enough to meet the headwinds. Now, having said that, Malaysia is a net oil exporter. Now, although runaway oil prices is going to drive up the subsidy bill, already the finance minister, Tengku Zafrul Aziz, expecting fuel subsidies to more than double last year to over $6 billion this year if oil prices remain over $100 a barrel. But for every dollar increase in oil prices is 300 million ringgit straight into the government's coffers. So all said, Malaysia has done its part, it's reopened, it's transitioning into endemic phase. The Prime Minister, Ismail Sabri himself, is facing a possible general election very soon this year, although not due till middle of next year.
Well, many thanks for that, Melissa Goh in Kuala Lumpur.